Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA.
Hello, welcome to the Risk Intel podcast. I'm Ed Vincent. With me today are Peery Heldreth and Amitabh Bhargava. Peery has a background in the agricultural sector, specifically spent 14 years in the farm credit system, and has a very unique perspective, having been inside the farm credit of the Virginia's organization. So we're excited to have Peery's perspective here today. Amitabh joins us as a senior credit officer at SRA, and Amitabh has worn various different hats related to credit and operational risk at Capital One for almost 20 years, and has been involved in the credit portfolio analysis here at SRA for the last several years as well. So Peery and Amitabh, thanks very much for being with us here today.
Thanks, Ed. It's a pleasure to be with you.
Thanks, Ed.
All right, today's topic is the agricultural sector and agricultural lending. So let's start by really kind of at the high level here, and talk about how big and important the ag sector and ag lending is in the U.S. So Amitabh, maybe you could give us a little bit of the lay of the land here, and some of the background about the size and scope of the agricultural sector and agricultural lending.
Absolutely, Ed. As we know, and that ag is a huge sector, and especially the ag-dependent sectors. So if we talk about just farm sector, that would be maybe about a little north of $500 billion in terms of gross revenue. But then we have to think about entire food services sector, the sectors related to restaurants. And if you throw all of them in, it might reach something like $1.5 trillion. So I would say ag and ag dependent sectors really constitute almost 1.3 to 1.5 trillions. And if we talk about just the farm sector, that would be nearly 500 billion. So it's a sizable revenue stream for the national economy. And in terms of lending, again, it's little north of $500 billion, because the ag lending is real estate related lending, as well as lending related to ag production. And the ag real estate lending, that's a bigger component. And also the players in the field of ag lending, we have in US a lot of commercial banks, community banks, they play in the area. But then a bigger component is the farm credit system, which is what Peery can talk to us more about and enlighten us. So that's again a very major player in this particular sector. Peery, you'd like to talk on about farm credit system?
Yeah, thanks, Amitabh. Right, maybe drill down a little bit there, right, Peery? Right, that's a pretty significant component here of the picture.
Well, it is, and with the farm credit system, being a GSE established in 1916 by Congress and the government, it is there specifically for ag lending. That's really that in the rural communities is what the farm credit system is there for. It's what was established to take care of, because as we know, in the U.S., agriculture, we have the most affordable, the most abundant, and the safest food source in the world. And we've got to continue to make sure that we have lending and agricultural component of that for our food sourcing going forward. So again, that's really what the farm credit system is there for, is to ensure that we have access to capital when it's needed, for all sections, whether that's for the real estate section, and as Amitabh talked about, that production side as well.
Thanks, Peery. Now, Amitabh, you just authored a report that looked at some of the changes and health and trends within the agricultural sector. So, can you share with us some of the observations that you had whether it's farm credit specific or more broadly, kind of at that higher level, about the agricultural sector and the health of that sector as compared to the last few years?
No, absolutely. So if we look at from a lender's perspective, the ag lending, overall, the credit quality, the non-current rate, and all those kind of metrics, they've been extremely pristine. Frankly, even in the latest quarter, the results which were released by FDIC for commercial banks, the non-current rate further ticked down from a very benign level that it was in early part of this year. And all that is because of a lot of tailwinds the sector has had. Very interestingly, since the pandemic hit, right in the beginning of, when the pandemic hit for first 2, 3, 4 months, the sector was very severely impacted because the consumption as well as the supply chains were adversely impacted by the pandemic. But then what happened is, because partly of the supply chain issues, overall the commodity prices, they scaled, significant highs, and that along with a lot of government payments which were made to the sector, that resulted in a lot of positive cash flow in the sector. The other piece is the low interest rate or practically zero interest rates that we've had for last few years. That resulted in a big boost to the valuation of farmland. So because the value of total assets as well as the total income and cash flows, they increased for participants in the sector, that resulted in a better solvency, better current assets, all those financial ratios, they improved. And the ability of the borrowers to meet their debt obligations was very strong. When we look at 2023 and forward into 2024, some of those same factors are now reversing out. So the commodity prices, they've retraced for most of the commodities, even though they still stay up. The government payments, obviously, it was all driven by pandemic. So that's, again, scaled back, even though it still stays a little bit above earlier levels. And the dollar, it continues to stay strong vis-a-vis some of our trading partners which are relevant for the farm sector, like Brazil. The entire geopolitical situation with China, it continues to be a bit volatile, resulting in fewer exports projected to China. So some of all those kind of things are going to act as somewhat of a headwind in 2023 and 24. And that is the reason, even though the overall metrics look very strong as of now, as risk practitioners, we just want to alert our constituents as to that we got to be a little bit cautious looking ahead for next few quarters.
Yeah, and to Ed, to that point, when we look at all of these programs, we've been sitting under the 2018 Farm Bill, and that ends this year. So
Right.
as we look forward, the number one concern and kind of risk within the industry is what that next Farm Bill looks like, how crop insurance may or may not be impacted, the forward pricing. There's a lot in the industry that's always tied to that Farm Bill, and right now we don't have one passed, and that is a huge concern in the ag sector, whether you're the farmer itself or whether you're lending to ag.
Right.
That next piece is going to be paramount to what risk looks like, going forward.
So you've highlighted a handful of risks there, right? Amitabh, you talked about some headwinds, whether it's commodity prices, right? Government payments, right? Geopolitical situation, right? Peery, you talked about the uncertainty related to the expiration of the Farm Bill and the fact that, right, we don't necessarily have the most smoothly functioning operation that is responsible for now getting a new bill through. that impacts both the farmer and the lender. Um, how do you manage this? How do you mitigate it? Right, the risks are going to be there. You can't eliminate them, but are there ideas or practices or suggestions that risk officers inside, whether it's inside a farm credit system institution or inside, someone lending into the agricultural sector, are there practices that they should adhere to think about and manage and prepare for these risks?
So yes, Ed, I think it is from the standpoint of working with the farmer when it comes to crop insurance, forward contracting, discussions around the seed that they're using, whether they need drought control or disease-resistant seed. Speaking of disease, animal husbandry. What are they doing with ensuring to keep disease out away from the animals? Diversification. Custom farming when it comes to feeding of other animals or custom harvesting. Also, custom hire work when it comes to repairs of machinery, entering a new commodity. Do you have a poultry operation and you could diversify into a beef operation? But a lot of things is definitely going to be around ensuring of good financial management. A couple of folks that I have a deep respect for, Dr. David Cole, Dr. Alex White, just hammer this issue all the time, when speaking out there of ensuring that you've got good record keeping all the way through, ensuring that you understand what your input costs are, and of course in the beef industry, what your price per pound gained. There's a lot of those types of things that really help with mitigation and risk control when it comes to that. And of course, with lending, it's always the 5 C's of credit.
Amitabh, right? Period. Getting into risks and risk mitigation techniques there. Maybe we zoom back out for 1 second, and then I'm actually going to come back to you, Peery, to perhaps talk a little bit more about how do you quantify those risks, and are there best practices around managing those. But Amitabh, in terms of the health of the borrowers in the agricultural sector, right? We were talking a little bit about health of a number of the players there, including the farms themselves. Can you talk a little bit about what you would evaluate when you're determining the health of borrowers in the agricultural sector?
Yeah, a lot of things would be same in terms of what would be for a typical commercial borrower. So one would look at value of assets. So one would, which is the collateral for the lending. And then you would look at what generates that NOI, the net operating income, the cash flows. The point in case of agricultural lending is that it all would depend on various geographies where the borrowers are located, what kind of crops or what kind of livestock or any other animal farming that we are looking at, because each one of them have their own supply demand dynamics, their own factors which cause their prices to go up or down. And a lot of these are not local, they are frankly global in nature, because what's happening in Ukraine or what's happening in terms of purchase paradigm for soy meal in China, or what is the pricing that Brazil, how they are competing with us, could determine some of these things. So I would say the lenders in this field need to be, in a way, keep abreast with a wider spectrum of factors, which are much more, which may vary from one borrower to another, especially if it is a lending which is across various geographies. So some of those things are very important. Another factor which very significantly impacts ag lending is climate change related impacts. And I want to steer away from any conversations related per se to climate change, what causes it and all. But the reality of the matter is that the frequency as well as the severity of things like drought or temperatures or precipitation, that has continued to increase over the last few years. And that does impact the yields and production of farms in a very significant way. So again, the ag lending sector, it needs to, in a way, stay abreast with how to assess that kind of risk when they are doing lending to a particular sector. And the last thing would be, as I talked about farmland values, they have risen very substantially. I would say that they have increased at a faster pace than residential real estate over the last few years. And as is standing today, when certain surveys are conducted, it seems that the borrowers, they still expect those prices to further go up, although moderate down, but still go up over the next few years. So there is always that element of, if that bubble were to burst or if the prices were to decline, how would lenders tackle their portfolios?
Right. I think I saw a statistic in your report, Amitabh, that 4 out of 10 respondents to the sentiment survey said that they expected farmland values to rise over the next year. Right. So that's pretty bullish, right? That is a positive sentiment there. But then what happens if that does not come to fruition, right? What is the how do you prepare for that, and how do you manage that risk?
Correct. Yeah.
Peery, let's bring this back then to kind of putting your hat on, right, as having been in a leadership role inside an institution that is facing these risks, as the president CEO of Farm Creditors Virginia. What are some of the best practices that you would counsel your fellow leaders within these institutions to consider, and actions they could be taking to, if not necessarily eliminate, but at least be aware of and track and monitor, and potentially mitigate some of these risks?
Well, I think that's you kind of touched on it in and of itself. Risk is there. You've got to identify it. You've got to ensure that you've got a metric in place. What is your appetite for it? What do you have in place from a standpoint of reporting? And then what is your plan as risks change? The risk appetite changes and things move around to the points that Amitabh just made. And so ensuring that you've got a system in place, that you've got that strategic planning there, the system in place to ensure that you've got the metrics that you're kind of looking for, engaging against. What does that look like? How is that built? What's the ease of it? How fast is it coming into you? And then, looking at those that are there with you to help and counsel you, through that, who are your partners, both in inside the organization, whether it's a chief risk officer or someone of that nature. But really, it's really comes down to that system and providing that information to you in real time, to be able to look at and make decisions and focus on the things that you need to be focused on as a leader, and kind of leaving the things there that doesn't necessarily need to focus today, but could need to focus tomorrow. And what does that system? How does that system relate to being able to provide that data to you timely enough to make those decisions and stay ahead of anything that's coming down the pipe?
Great insights. Thank you, Peery. Right, and a few things that caught my attention there, right, about quantifying the risk, whether that is understanding the risk themselves, understanding your risk appetite, and anticipating how you're going to react before you have to react. So quantifying, having action plans in place, and then being able to get your hands on this data in a timely manner, right? Strong reporting, robust data collection, strong aggregation, having it in a central place. Whether you do that yourself with an internal homegrown system, whether it is right with shared documents, or whether it's with a third-party system, right? Those key aspects of quantifying the risk, having plans in place to respond to various scenarios, and then being able to ensure that you aggregate that data in a really timely manner. Thank you very much for your insights today, gentlemen. We appreciate it. Certainly, I encourage all of our listeners and viewers here to go to the SRARisk.com website and grab Amitabh's report. And we appreciate Amitabh and Peery. You both been with us today and sharing your thoughts on trends in the agricultural sector. Thank you, gentlemen.
Thank you.
Thank you.